and welcome to the Mutual Fund Show. My name is Neeraj. Over the next 25 minutes, we'll talk about a particular sector or a particular part, or how do I say, a segment of the mutual funds on the debt side, which is dynamic bond funds. The first guest today on the show, George Heber Joseph of ITIMC, REA Mutual Fund, will join in and talk about why does he believe that dynamic bond funds could essentially be the debt option for all seasons. Then, of course, we get in Raghvendra Nath of Ladderup to talk about his view on the same, and then give us some advice about which mutual fund scheme does he believe people can park some money in, considering that the markets seem to have scaled up new highs in the recent past, and therefore the risk reward maybe not as favorable as it was some quarters back. But first, onto the main topic of the day, and which is debt product that everybody can keep an eye out on, considering the kind of interest rate scenario that we live in. George Heber Joseph, as I said, joins us. He's the CIO and CEO of ITI Mutual Fund. George, great having you. Thanks so much for joining in.
Thanks, Neeraj. Nice to have me on this show.
No, the pleasure is ours, George. So must be getting difficult, right, George? Trying to figure out what will happen to the rates, and therefore what kind of fund should one choose, considering what the US is saying, considering what the Indian central bank is saying, and considering what's happening to inflation, irrespective of what the bankers are saying.
Yeah, absolutely, Neeraj. It is a very complex subject. You need long-standing experience to understand, what happens to the interest rate scenario as well as the inflation moving up scenario, which is the current scenario which we all are painting. And also to make money in the whole scheme of things, it becomes a very complex subject for a layman. But that's why if you look at the current structure of the interest rate movements, what we have seen and what we believe in is that there is this clear possibility of the inflation moving up. But global inflation is moving up, and also the Indian inflation moving up. So there is a clear chance of interest rates moving up because of the inflation is a very, very clear determinant for the interest rates also. So we are clearly posing for a situation that maybe in a 3 to 5 years time, the interest rates will be significantly higher than what it is today.
So, but that's some time away, right? So my question, therefore, okay, the central point about this would be that a lot of people currently are looking at interest rates and the return rates the way they are, the savings rate or the risk-free rate the way it is, and trying to contemplate as to where is it that they should park the money to get the maximum buck for their buck in not on the equity side, but on the debt side. Equities choices might be relatively simpler. On the debt side, it's actually very confusing. What is your thought here?
Yeah, absolutely. When we look at the recent past and what has happened in the industry, mutual fund industry also is, there is a lot of pessimism around the debt products, mainly because of the fact that people started believing that equity is more less riskier than debt, which is not the case. So we have a strong belief that risk-adjusted basis debt stands out even today compared to equity. And if you want to have long-term returns, which is safer, relatively safer, and also build a clear wealth bucket, which you want to, or asset allocation mix that you need to have. I believe that there is a requirement for debt product in your portfolio basket. So if you look at the problem which an investor faces, that they don't know which part of the interest rate cycle we are in. Secondly, people don't know which product to choose from, because there are 16 products, one mutual fund, or the category of products in the debt side itself quite enormous. So there are 45 mutual funds. So the things becomes very, very complex. So you don't know which product to choose and what kind of risk each product is carrying. Now when you say dynamic bond fund, that doesn't mean that all of the dynamic bond funds are run in the similar fashion, because each one has its own philosophy of running it. So that's where the complexity comes. But we believe that we are looking at as a solution rather than a product, and that is where we think that we are making it a clear differentiation.
Care to explain when you say that dynamic bond fund is not homogeneous and is being run very, very differently? Care to elaborate on that point a bit, George?
Yeah, if you look at some of the funds, there are certain credit papers being bought into the dynamic bond fund also. Or say for example, inferior quality bonds are also taken. That's where a lot of chaos has happened in the industry. And also there are bond papers which is very illiquid as well, even if it might be a reasonable quality, but it is illiquid in the market, especially when it comes to corporate bonds. So that's where we think that uh, and different products are run in different fashion, as I mentioned earlier. But that's where you need to have a USP which creates liquidity reasonably well in the product. Secondly, you need to have high quality bonds in the basket, and also you need relative safety. So that is what an investor is looking at. When after talking to various mutual fund distributors and various wealth outfits, what I could clearly gather is that this is the pain area for investors, that they don't know which product to choose from. And there is a very varied variety of funds in the market within the dynamic bond funds. So that's where we saw an opportunity to place it very uniquely, uh, very interestingly, to make it so liquid, and also have a majority basket of the bonds as the government bonds.
Okay, can you tell us, George, what does a dynamic bond fund typically do? What do you mean when you say that others are doing it differently, and when you are launching a product, you will do it differently?
Yeah, for Neeraj, if you look at what is a dynamic bond fund, the bond fund is supposed to move the papers what you're going to buy in the bond fund has to move from different maturity buckets, from a low duration bucket to high duration bucket, according to the interest rate scenario as well as the conditions of the market. Now, that has to be easily being done. When you have very illiquid papers in the portfolio, what happens is that you cannot, even if you spot the opportunity, you are not able to move from one maturity bucket to another maturity bucket. That is a problem, typical problem fund managers face. That's why we thought that here what we are looking at in a bond fund is that we want the quality of the papers to be utmost important, which itself means safety, relative safety, and relative liquidity is very much given. An investor doesn't need to worry about whether if I pull out money tomorrow, whether I will get my money back or not. Ultimately, bond is nothing but you are giving a loan to a company, or loan to a third party. So that's the way I simply put. Whereas in equity, are owning shares. For here, liquidity is paramount importance. So we have a simple investment philosophy which we have put in place at ITA Mutual Fund, as SQL. S for margin of safety, Q for quality of the business, and L for liquidity. So all these three things have to coexist in the product, so that the product becomes very successful from the investor perspective.
Okay. You're effectively trying to say that investors in your product need not worry about return of capital. They have to worry about return on capital. But that's where the question would come in, right, George? That the return on capital, when you have everything, like all the three factors out there, would not be, for lack of a better word, competitive, right? It would be returns that any other average well-doing AMC, which takes all of the safety into place, would be able to dish out, right? Because you can't have higher returns when you opt for all the three parameters that you just mentioned, or can you?
That's right. Dheeraj. The typical thing what we have seen is the fund manager has if he is having a long-standing experience. So in our case, Mr. Vikrant Mehta is having 25 years of experience managing funds, and he is our head of fixed income. So he clearly believes that the portfolio has to be highly liquid. For that, we are having it 80%, 60 to 80% in government bonds. And it typically means that you look at various maturity profiles and see where the opportunity lies, and move the money very dynamically. And there will be, as you have seen in equity markets, that same thing applies in debt market also, that risk on and risk off keeps happening, and you have to spot the opportunity in which maturity bucket the opportunity lies. Today, for example, the 10-year GSEC, almost 80% of the bonds are with RBI. So if you look at the opportunity lies elsewhere, between 3 years to a 10-year bucket, or beyond 10-year bucket, there is an opportunity which we clearly see. So if you want to place the opportunity at timely fashion and take out also, liquidity is a paramount importance, and which is what a dynamic bond fund has to clearly focus on, and that is what we believe we will be definitely doing it without taking any inferior. So we are not going to play credit, we are not going to play InvITs or any fancy papers. We are going to play the interest rate cycle very clearly through the government bond basket, and play through the entire interest rate cycle very seamlessly. So you need experience, you need have the product knowledge, as well as have a process to run this model very nicely, so as to achieve a superior risk-adjusted returns related to the industry.
Final question, George. Is the dynamic bond fund the best suited product at the current juncture, wherein the rates, yes, I heard you say that the rates will be higher in 3 to 5 years, but there is a probability that the rates will be higher even sooner. So is this the best option on the debt side, or would you reckon there are other options which are comparable for somebody who is betting on the fact that rates will move up in the next 12 months?
Yeah, but again, coming to the point that typically an investor doesn't know where to place the bets, right? And secondly, the typical problem investor faces that which product to choose from, and what are the risk levels involved in these products. So all three are a complex subject. So what we want to make is that make it a very simple solution. And my experience is that in my previous stint at ICICI Pru also was that if you identify need of an investor and create a product around it, which was BAF, for example, the product designing and the entire modeling was done by me, and eventually that became a very successful product in the market and became a category by itself. Now today, all season bond funds are there, run by different industry participants. But if you create a very niche positioning for the product which meets the need of the investor, then that product can be a very scalable opportunity. And also at this juncture of the interest rate cycle, where the interest rates can move here and there depending upon the risk on risk off scenarios happening globally as well as and the bond buying slowly coming off from the RBI side, you can have it needs a very expert hand to maneuver this entire scenario. And that's where we believe that dynamic bond fund provides a very fantastic opportunity to move between maturity buckets and capture the opportunities which is coming up in different baskets. So which is what we will like to do. So in my view, as to answer your question in a nutshell, it is one of the best products in the entire debt category is what we believe, and this will be our flagship fund for ITM.